welcome back to our channel. If you're enjoying our content and want to show your support, we have an exciting offer for you. Join our Patreon community for exclusive perks and channel support. And the best part? We're offering a free 7-day trial for new members. By subscribing to our Patreon, you'll gain access to bonus videos, behind-the-scenes content, and even the opportunity to participate in live Q&A sessions with our team. It's a fantastic way to engage further with our community and get more out of your viewing experience. So don't miss out. Click the link in the description below to join our Patreon and take advantage of this exclusive offer. Welcome back. It's time to catch up on what has transpired since our last discussion. Let's delve into the recent developments, starting with the notable reversal seen in Salesforce. Interestingly, this is precisely what we were apprehensive about. As we talked earlier this week, the winners in the market were bound to face a shift in fortunes, and as a result, we decided to sell off AMD and a few other stocks. It seems we are currently experiencing a significant moment, one where we must navigate the waters and merge into alternative stocks. Discussing rotation, undoubtedly, these rotations have been quite impactful. Personally, I find it reassuring that we are witnessing a shift towards economically sensitive stocks, particularly those that had lagged behind due to the rally in May. The S&P, while recording a slight decline, was primarily driven by artificial intelligence, AI. One of the sectors that underperformed in May, energy, unexpectedly emerged as the top performer this week. It's quite astonishing, to say the least, and could potentially indicate a mean reversion phenomenon taking place. Tech stocks and diversification. Earlier this week, I expressed my concerns about the market broadening its scope, as it meant that many technology stocks would need to readjust. Companies like Microsoft are not down for no reason. Their declining performance signals a change in market sentiment. This is precisely why we have had to raise capital. Perhaps we should have sold some Amazon shares as well. It's essential to recognize that battling with stocks is sometimes necessary, as they don't all behave in the same manner. Relying solely on Alphabet and Microsoft would have been a brilliant move a few days ago, but today it would have been a regrettable decision. Maintaining a portfolio with diverse holdings and standing gains is crucial. Embracing this perspective allows us to navigate the market with calmness, understanding that individual stock movements are part of a larger picture. The baseball lineup metaphor. To illustrate the current situation, let's consider a baseball lineup. Rarely do all 9 hitters perform exceptionally well at the same time. Occasionally, the second or third hitter must compensate for a slowdown in the leadoff or cleanup hitter. For example, Kyle Schwarber struggled in the first 2 months of the season but is now finding his stride in June. The same concept applies to the market. Some stocks have moved excessively, while others are catching up. However, it's important to note that this is not necessarily indicative of a positive trend. It's simply a churn, lacking any specific reasoning behind it. Stocks like ITW and Caterpillar experiencing sudden rises are merely playing catch-up. Once this process reaches its conclusion, we can anticipate a downward trend. Identifying catalysts. In our attempt to pinpoint catalysts for these market shifts, we could consider factors such as the debt ceiling agreement or robust jobs data, which showed significant gains in May. These positive indicators suggest that a recession is not imminent, which may have influenced investors to switch gears. Specific stock analysis. Allow me to share some insights on particular stocks. Foot Locker, for instance, has finally started to show signs of bottoming out, although it's not yet ready for investment. As for our holdings, we have retained Alphabet and Microsoft, sold AMD, and downgraded Palo Alto. It's worth mentioning that once the market fully broadens, we can expect a downturn, after which we will restart the process. While some may argue that we should be swiftly exiting certain positions if we were running a hedge fund, it's important to recognize that our approach is different. Thank you for tuning in to today's video. If you found it informative and enjoyable, please consider subscribing to our channel. By subscribing, you'll never miss out on our latest updates and future videos. Don't forget to hit the notification bell to stay notified. Also, don't forget to join our Patreon community for exclusive perks and to show your support. We appreciate each and every one of you. See you in the next video.